Good morning. It is Monday the 9th. On today's agenda, Takaichi's historic triumph, China warns on Treasuries, and Starmer on the brink.
Tom, there's some really interesting moves developing in the bond market right now. Let's talk about what is happening. As you say, Takaichi wins big. The Japanese 10-year goes higher, 30-year goes higher. Is that the repatriation trade beginning? Does it give legs to the repatriation trade back into Japan, out of Treasuries? You've then, as you say, got the Chinese talking to private investors saying, curb your enthusiasm around what is going on in the Treasury market. Be careful. US Treasury yields go higher on the back of that. What does it all mean for precious metals? Well, it's another boost for the gold trade this morning. That is back north of 5,000. We're up by 1.25%. It's going to be a big week for the bond market. The countdown to the opening trade starts right now.
Good morning, everybody. It is Monday the 9th of February. In fact, this is the opening trade, and politics is everywhere. This is going to be, as you say, Guy, a big week for the bond markets. Politics on display, strength in politics over in Japan, weakness in politics here in the UK, and the influence of politics on our macro data agenda in the United States. We have we're looking ahead to a cluster of data points that could be huge for bond markets, for investors globally, as a result of the politics.
Now's not probably the time to have a political crisis in the UK. Let's just put it that way. This could be not the week maybe to deliver that, but let's talk about the positive politics coming out of Japan. Takaichi wins big. She kind of had a snap election, one of the fastest snap elections I think we've ever seen, and she has smashed it. The LDP has a super majority. We are going to see, therefore, some quite big changes in Japan as a result of that. Are we going to see her spending as freely as maybe some suggest? A little bit of caution maybe creeping in on that front. But she won 316 seats in the lower house. It is a huge victory. It's going to change the relationships in Asia in a big way. You've got a constitutional change potentially coming, potentially a more bellicose, a more militarized Japan. China's going to be worried about that. The ripple effects of this could be massive.
You march the JGBs, and we are selling at sell-off then at the front end. Well, the front end, the 10-year, where yields are up. Yields are up, but, you know, the Japanese context, when you go up to 40s. The 10-year selling off, so up 5 basis points in terms of yields. So the question for market seems to be, does this significant historic win for Takaichi, the first time we've had this kind of majority for the LDP since the Second World War, does it allow her to go bigger on stimulus, or does it actually give her the political mandate to ease back on some of those spending plans because of the political mandate she has? And the opposition parties were pushing for more spending. So one reading for the markets would be we're probably going to get less spending than maybe other political dynamics could have left. But for now, the question is, how far does she go? And so we're listening into her, and we're listening into her members of her cabinet as well around the currency. Yeah,
because this going into this election, we had been all obsessing about the long end of the curve, and we haven't seen a huge amount of move there, but we have at the 10-year, as you say. And that had been around fiscal concerns that maybe more spending would happen, and maybe that was the wrong lens. It's interesting how political clarity and large mandates, large amounts of power concentrated, can have this impact on markets, isn't it? And really focus opinion. Something that might have been seen as a risk previously, suddenly if you're going to get policy effectively delivered, the market thinks, oh, maybe actually that might not be so bad.
Interesting to see how the BOJ reacts to this. Does it accelerate or decelerate kind of what happens at the BOJ? The interesting thing this morning is that this fits into a wider narrative, and that is that we are seeing some potentially quite significant pressure being applied to the Treasury market. So you've got a big week coming up for the Treasury market, haven't you? And you've got this news story, which we added this morning, on China.
So what is bigger then for the Treasury market? Is it the inflation data that we get out of the US later this week? Is it the jobs data that we get out on Wednesday? Or is it this jawboning from Chinese officials talking of their lack of concern about stability in the Treasury market, jawboning, at least verbal rhetoric for some of their lenders out there who hold about close to $300 billion in terms of dollar-denominated debt? This is a Bloomberg scoop. Chinese authorities leaning on their banks and other financial institutions saying, be cautious in terms of your exposure to US Treasuries. To be clear, this is not the Chinese government saying we as a government are going to stop buying US Treasuries. There is that distinction. But nonetheless, this is significant, and you saw a move in Treasuries on the back of this.
And you could either cast this as a politically motivated story, tension between China and the US, China pulling levers, power, that it has in large Treasury holdings, or at least leaning on others to do so. Or you can say this is an extension of that de-dollarization conversation that many people around the world have been having, given the credibility issues that the dollar was facing up until recently.
It could just be a warning, just saying, you know what, we see volatility in the Treasury market. Just be careful. It could be as simple as that. But the issue, and we talked about this with Europe a few weeks ago, is all you've got to do is just not buy as much. The marginal impact is huge if you don't buy as much. If the rest of the world doesn't buy Treasuries, that implies higher yields in the United States.
And yet foreign holdings of US Treasuries have actually gone up. They're above 9 trillion. And the UK is now amongst the biggest buyers, ahead of China.
And as you've been saying, this is a busy week in terms of data points that we know are coming, the clustering of these data points. We have retail sales tomorrow, payrolls on Wednesday, CPI on Friday, and a 10-year auction in the mix there as well. So maybe that Chinese story gains relevance as we head towards the middle of the week, 4.5 hours between the payrolls data and that 10-year auction. So we'll certainly watch how that one goes. Shall we pivot to UK policy?
It is connected. Is this a week you want to have a political crisis? Probably not. If there's turbulence in the Treasury market, this could be quite dangerous for the UK.
Up until yesterday morning, it wasn't clear whether the very important aide Morgan McSweeney was going to go, but now he has. We know. Closest aide has gone. This is to Keir Starmer, and he said in his departure he takes full responsibility for the appointment of Peter Mandelson as ambassador to the United States, which of course is what has driven the most recent crisis judgment, whether Starmer's judgment was flawed in appointing Mandelson. Now, markets have reacted and also not much reacted to this story. So we have seen a bit of weakness in the pound, but it's flat against the dollar. There has been a bit of movement against the euro, and that's where we're watching, because Goldman Sachs is talking about how we could see 6% drop in 12 months there. Nomura talking about a 3% drop, and they're possibly not factoring in a huge amount of political turmoil there. So if we get political turmoil, what does that do? We're back to talking about whether there are any candidates within the Labour Party who can feasibly take over. And these things, as we saw with Corbyn in previous iterations of this, can be extremely unpredictable.
We've seen, in terms of the market mechanics around this, yield steepening over 12 months. And we've seen, of course, volatility when Rachel Reeves, for example, cried in the House of Commons and there was a sell-off. The markets seem to like the stability of Rachel Reeves and Keir Starmer, or maybe it's a question of better the devil you know. But what we've seen is pretty significant moves into the front end. So yields are down 50 basis points on the 2-year in the UK over 12 months, and they're up about 30 basis points on the long end. So in terms of that steepening story, how does that adjust? How much risk premium do you start to price into the UK markets if we do get someone from the left of the party looking to take over from Keir Starmer?
The market does feel like it's moved on from that Rachel Reeves moment, though. She didn't go to China. She's been sidelined. There's talk this morning of the fact that she may not even be there to deliver the spring statements, not budget, that a junior minister might do it. She's already been sidelined. So is the kind of the risk that the market reacts violently because it doesn't like the instability, has that moment now passed? It seems it has.
Yeah, I mean, it is another take on that story that they're trying to downplay having a second fiscal event, so maybe you let someone else... Anyway, but the focus today is on Keir Starmer's going to speak this morning, deliver a quote-unquote intervention at some point today, so we'll see what that can deliver. And, of course, this comes before the May elections, local elections, so is there point in reshuffling the decks now, or do you wait and make a statement after that? So that could be an important data point or date to keep in mind. 7:08 here in London. Let's tell you what is coming up in the programme in terms of the conversations we're going to have with our guests. We're going to be joined by Yusuke Miyairi, who's going to be with us to talk all things Japan, G10 FX strategist over at Nomura. Where does the yen go next? Paul Jackson, global market strategist EMEA at Invesco. We perhaps will start the conversation there around UK politics and the way that is influencing bond markets right now. Helen Jewell, international CIO, fundamental equities, will be with us. Lots to digest, thinking about what we saw last week, that volatility in software stocks. Where do we go next on the equities story? And we'll also be speaking to Vikas Dwivedi, who is global oil and gas strategist at Macquarie. A little bit of a retreat in oil prices this morning on the back of a lack of activity over the weekend in the Middle East. Yep,
still waiting and watching very carefully on that front, though. What else do we need to know this Monday morning? A Hong Kong court has sentenced pro-democracy former media mogul Jimmy Lai to 20 years in prison. It is the harshest sentence to be given under the Beijing-imposed national security law. The judges ruled that Lai was the, quote, mastermind of the conspiracies and therefore warranted a heavier sentence, with the punishment being effectively a life sentence. Bloomberg has learnt that Anthropic is finalising details of a funding round likely to raise more than $20 billion and slated to close as soon as this week. The company was initially, we think, seeking around $10 billion, but it's now on track to raise more than double that amount at a $350 billion valuation for the firm, thanks in part to excess investor interest after last week. Unsurprising, you could argue. And the Seattle Seahawks are the Super Bowl champions. They dominated the New England Patriots 29-13 to win Super Bowl 60. The Puerto Rican superstar Bad Bunny making history, becoming the first male solo Latin artist to headline the halftime show. His performance, which was entirely in Spanish, drew quite significant criticism from the President of the United States, as you can see on the screen right now. Big defence, massive defence.
It's all about the defence, isn't it?
Like I haven't watched the game because I was asleep, but I've seen some highlights. And the Patriots didn't score for, until the back end of the game.
Glad you're here to tell me this, because I saw much more write-up of Bad Bunny than I did of the actual game.
Well, the Bad Bunny stuff was on the front pages, injecting fun, and then President Trump says this is one of the worst performances in terms of the Super Bowl that we've seen ever. Who could understand what he was saying? Of course, he was speaking Spanish. So there's a significant proportion of the US population.
Massive weekend for sport, though. The Olympics were amazing. And so much going on there, plus also some fantastic rugby.
I've been brushing up on the rules of curling. Just so, come Friday, I can engage in some serious conversation
that
on this
crash
sport.
For Lindsey Vonn.
That was horrific.
Yeah, she's recovering, fortunately recovering on the back of that fall. Coming up, we will be watching UniCredit, switching focus from sport to what's happening in the banking space, of course, this morning after their fourth quarter net income beat estimates. The Italian banking giant also saying they will return about 50 billion euros to investors in the next 5 years. Plus, later we're going to check in on oil as those easing Middle East tensions between the United States and Iran reduce supply risks, at least in the near term. Up next, we'll be checking back in on Japanese assets, of course. Japanese stocks ripping higher after Prime Minister Takaichi's landslide and historic election victory. Numerous Yusuke Miyari joins us on set. If you have any questions of your own for our guest, send them to us on IB plus BBTV Go. This is Bloomberg.
Welcome back. Monday morning, 45 minutes to go until the equity market session here in Europe. We've got a little catch-up still to play versus the very strong finish we saw in the United States Friday. That needs to be priced into markets this morning. So we're up by circa 0.5% on futures right now, pretty much across the board.
Yeah, absolutely. So Friday lives on into Monday, but we add some new news lines, and one of those comes out of Japan. Japanese Prime Minister Sanae Takaichi has secured an historic election triumph. Her win now positions her as the nation's strongest leader in the post-war era. Joining us with the latest from Tokyo is Bloomberg's Japan economy and government reporter Erica Yokohama. Erica, really good to have your reporting on the programme. So was this election result expected? We went into the weekend, yes, expecting her to win, but the scale of the victory, how unexpected was that?
Yeah, exactly. So the market was expecting the LDP sweeping victory, but the scale was far larger than any forecast in local media. So Takaichi has clearly strengthened her grip on power. Now there is a strong momentum for her to push ahead with her agenda from economic policy, defense ramp up, and growth strategy and more. The LDP secured 316 seats. That's clearly the majority on its own and marking the largest number for a single party in post-war history, as you said. And together with its coalition partner, Ishin, the bloc now holds 350 seats. This is a major breakthrough because before the election, even with Ishin and some independent lawmakers, the ruling camp only managed a slim majority of 233 seats. And, the LDP picked up many seats from the centrist Reform Alliance, newly formed opposition party by LDP's long-term ally, Komeito, and Constitutional Democratic Party. The co-leaders of CLA are now considering resignation of the position.
Okay. Let's talk about what the Prime Minister does with this huge majority. Everybody's trying to work out, is she going to spend big or are we going to see more responsible fiscal activity? What's top of mind as she starts her new tenure?
Yeah, so the market is kind of expecting that the Takaichi will further proceed with the larger spending, but at the same time, she's pretty cautious as well. What was surprise for me yesterday was Takaichi actually started her speech after post-election speech by saying that the government is really paying attention to fiscal sustainability. And Finance Minister Katayama said the consumption tax cut, which is a long-term concern for a lot of market participants, is just for only 2 years on food, and it won't require additional debt issuance, just making sure that Japanese finance is kept in check. The first things she has to do is actually to get in the budget for the year starting in April through the diet. And, the ruling coalition is still in the minority in the upper house, so some amendments there are possible. So maybe that's something Takaichi has to do first before thinking about the new spending things.
Okay, Bloomberg's Erika Yokoyama in Tokyo with that update on those historic election results in Japan. Thank you. Let's stay with that and the market perspective, and with a particular lens on the currency space. Let's bring in right now Yusuke Miyairi, a G10 FX strategist at Nomura. Yusuke, thank you for joining us round the desk this morning. Obviously, really, really significant in terms of the electoral outcome for Takaichi. Which Takaichi turns up, do you think? Is it the Takaichi who is willing to spend big and cut taxes, or is it the Takaichi who's going to be more fiscally responsible than maybe some had expected?
Yeah, that's a big debate in the market right now. Initially, she wanted to go big in terms of fiscal, but now she's started to understand the market volatility, what could be the pain for her when market volatility increases. So when we listened to her speech and TV interviews yesterday, we think that she's more skewed to being responsible rather than proactive, under her slogan of responsible and proactive fiscal policy. So should she be responsible about the fiscal policy? We think that would be a relief for the JGB market and also relief for the yen weakness. So overall, if she sticks with her responsible fiscal policy, I think that's going to be positive for the fixed income market in Japan.
What does that mean if we stick to the? I mean, there's obviously the interlinks between the JGBs and the yen, but with your view on the yen, which has rallied in the session today, and maybe part of that is down to weaker dollar. What is that direction of travel for the yen in that scenario then?
So in near term, I think we should also have to pay attention to the equity market where it is today it boomed. Along with that, I think their near-term risk is that dollar yen would go gradually to the upside, but at the same time, if you go to like $1 yen go 160, then you have to be aware of the FX intervention risk by the Ministry of Finance, and possibly from the U.S. Treasury side as well. So we think that the upside of the dollar yen is capped, and as if the Prime Minister Takaichi, maintains her responsible fiscal policy, I think the direction of travel of the dollar yen will go to the downside towards the middle of this year.
What does it mean for the BOJ?
We think the BOJ will hike 2 more times this year and 1 more time next year. But if the yen weakness just sustains, then I think the BOJ needs to hike more. If you see the break-even inflation in Japan, it has now reached 2%. And some investors are thinking that the real policy yield in Japan is so low compared to other G10 peers. So in the BOJ,
where's the line for the BOJ on the yen?
So I think 160 is, I think, a key level for not just BOJ, but for Japanese officials as well. But so if we go again 160, then I think the BOJ...
Do you get a quick rate hike? If you get to 160, does the BOJ... how quickly is the reaction?
So I think 1 cent a quarter is the quickest pace. I think back-to-back cut for the BOJ is still a very high hurdle. Yeah.
Okay, so once a quarter then is the quickest pace we can expect, because they've been going slower than that. On the consumer tax, on the consumption tax, where we started the conversation, so the finance minister has said a number of times, she keeps saying, this is not going to result in more borrowing. We're not going to raise debt as a result of this. But have they said anything about how it's going to be funded? Wouldn't that be an easy way to sort of take the pressure out of the JGB market by just saying, well, we're going to cut consumer taxes on food only for 2 years, and this is how we're going to pay for it? It's the unfunded nature of it that spooks markets, right?
So actually, she hasn't said anything about the funding yet. She said that she will discuss at the National Council with other parties as well to how to fund for it. That means she does have a leeway to ultimately not do consumption tax cuts and do other fiscal measures to curb inflation in Japan or increase the real wages in Japan. So our view is that she hasn't strongly committed to implementing consumption tax cuts, although the majority of the public and the majority of the LDP lawmakers support the consumption tax cut. So how she will manage that will be obviously a key going forward.
Yes, and you wonder what the mandate was driven by, but I suppose that's difficult to say. Something that is difficult perhaps to pin to markets, but I wonder how it affects JGBs and expectations of debt load, is a pivot to a more nationalistic Japan, a Japan that will spend on defence and perhaps changing the constitution to allow that to happen. I mean, that's a step removed from markets maybe at this point, but how does it fit with the markets conversation, Yusuke? Is this something that bond markets are going to be watching?
So, I think national defense spending, I think the direction of the travel is to increase it. And I think that is kind of inevitable these days, what's happening outside Japan. But it's not just like, Japan choosing either U.S. or China. Japan is trying to be, insulated from these two countries or other part of the country. So Japan to be independent, I think that's the key for the national defense spending. But for a constitutional change, you need a 2/3 majority in the upper house as well. And the LDP hasn't got that yet. So I think that's still, we still have a distance to discuss that. But I think the, direction of travel of the national defense is going to more increase.
Are we going to get repatriation?
That's $1 million question, obviously.
Yeah.
But I think two things are key here. One is the market volatility, especially in the JGB market.
Yeah.
If you see the carry-in role of the JGB yield curve, it's very, very attractive. But Japanese investors haven't yet repatriated. I think that's one is factors
what gets
of volatility.
them? Okay, well, we got the election out of the way. We've got a massive LDP majority. We've got a BOJ that's hiking 2 or 3 times. What gets the repatriation story going?
So I think this is the base of our conversation here. So it's the fiscal policy. So if Takaichi says that she's going to be very responsible, and if she doesn't do too much on the fiscal side, I think Japanese investors will become more attractive in buying JGBs, especially on the long end, 10 years or super long.
Buying big or just at the margin?
Greater than now.
Greater than now. Yes. Okay, at the margin. Yeah, okay.
We have a great deal of political clarity now in Japan, and with that comes the sort of ability to execute big, and it might be around the things we've been talking about. Are there policies that maybe have not, because we seem to spend a lot of time talking about this consumption tax, Yusuke, are there other policies that we need to focus on, pro-growth policies maybe, that we need to understand?
Yeah, I think so. Takaichi has established a council to target like 17 areas of the economy for, like, example, shipbuilding, like space, robotics. So there are those sectors. But from the fixed income market side, I think what's important is whether Takaichi will go big or not. But for the equity space, there are those sector theme trades going on. So those sectors are attractive.
On the equity space, before we let you go, you said you think dollar yen is capped at some point. Obviously, Japanese equities benefited from weaker yen. What is that a potential drag? I mean, it's another very strong day for Japanese stocks. Does that narrative then of maybe a slightly stronger yen longer term, or at least in the medium term, does that cap the kind of gains we've seen in Japanese stocks?
So if, say, for example, that dollar yen drops sharply, like we saw in summer 2024, then that's going to be negative for the Japanese stock market. But if you see the Japanese corporates like earnings that are being resilient relative to the FX movement, and there are big themes like corporate governance changes, etc. So those structural shifts will likely to support the Japanese stocks going higher.
Really interesting. Yusuke Miyaiiri, G10 FX strategist at Nomura, with the market implications, of course, on that victory for Takaichi. Coming up, from the political stability then of Japan to the instability here in the UK as Prime Minister Keir Starmer's future hangs in the balance, we will discuss what it means for the pound and the bond markets with Invesco's Paul Jackson. Stay with us. This is Bloomberg.
Welcome back. This is the opening trade, 7:30 this Monday morning here in London. Let's have a quick look at the futures picture then. And the memory of Friday seems to be living on in terms of equity markets and that story, because we saw real strength coming through in US stocks on Friday, of course, up by more than 2% on the Nasdaq. If it's all about diversification, not just about tech, the Dow doesn't get many mentions on this show, but that was also up by more than 2%, which seems important for a change. So we've got European equity futures pricing in more strength, Guy, at the start of our European trading day. We add in, of course, the positivity, risk appetite coming from the Asia session and Japan.
If the Chinese are advising their funds not to, or at the margin, not buy US Treasuries, are they going to buy European bonds? So that's a question. Do you get a rotation out of the US into Europe as a result of what's being said? At the moment, it's a very mixed picture in terms of the European bond market. Not much movement at this point. I think the big action may come at 8 UK time, when we get the gilt market.
We will be glued to moves in the gilt market on the back of the volatility in UK politics, because the UK Prime Minister Keir Starmer's future now hangs in the balance after Morgan McSweeney quit as his Chief of Staff. That follows backlash, of course, over Peter Mandelson's appointment as UK Ambassador to Washington. Reform UK Deputy Leader Richard Tice told us earlier that this is just the beginning.
Morgan McSweeney's resignation, it's just the beginning, because over the next few weeks, what is going to be released via the Intelligence and Security Committee is the depth of messages and emails that have gone on in and around Number 10 in the run-up to the appointment of Peter Mandelson and subsequently, and also his involvement at the heart of this Labour government in the run-up to the election and afterwards. And I think as those come out, if the Prime Minister is still Prime Minister at that time, that will effectively finish him off.
OK, that the view, of course, of one of the UK opposition parties, the deputy head of UK Reform, of course, Richard Tice, talking to us earlier. Let's bring in Bloomberg opinion columnist Rosa Prince now for another view. Rosa, does Starmer last the week?
That's the great question. Now, it's quite hard to get rid of a Prime Minister, particularly a Labour Prime Minister. And Starmer's been under pressure for months now. And really what's kept him in place is that nobody has had the kind of nerve to stand up and challenge him. And that remains the case. Now, I think the two big factors for this week and whether he survives in the short term are whether the cabinet are still with him. If a major cabinet minister said, I can't stand this anymore, I'm going to resign, if he had a couple of resignations, I think he would be gone immediately, or if his own Labour MPs turned on him. And they do seem pretty upset with him. So people have been talking about 50-50. I think that sounds about right to me.
Rosa, who's going to be the next Prime Minister?
Ooh, that's a difficult one. And like I say, really the issue with replacing Keir Starmer and the reason it hasn't happened already, because he's been in trouble for so long, is that there isn't an obvious replacement for him. Angela Rayner, who was his deputy, she's had to resign in a scandal of her own because she didn't pay full property taxes. My money, therefore, would probably be on the Health Secretary, Wes Streeting. He's a good talker, he's very charismatic, but he has issues too. He also was close to Peter Mandelson, and he's not universally liked in the Labour Party. It's unclear he could win a leadership contest. Then some other candidates, just to throw some names out there, are Ed Miliband. He was leader once before. He's also from the left of the party, so might be popular with the party, but not necessarily with voters who have already rejected him as Prime Minister. And then there's Andy Burnham, who would be popular both with Labour MPs and with the public, but is not an MP. And at the moment, the rules are that you can't be Prime Minister and therefore Labour leader if you're not a Member of Parliament. So not a clear answer to that question.
Yeah, it seems even more difficult to answer, doesn't it? The list seems to be growing. Rosa, thank you very much. Rosa Prince, Bloomberg opinion columnist, on the latest in UK politics. Let's dig into the implications for UK assets then. We're joined by Paul Jackson, global market strategist, EMEA at Invesco. Paul, good morning. Happy Monday for you. Let's talk about what's going on with UK assets then. I mean, we've got the pound as a bit of a barometer. It's the only thing that's open right now. It's not moving all that much, though, on this. Maybe this development was kind of priced. Maybe we're where we were on Friday. We look to gilt markets to show us a little bit more volatility, perhaps, and see whether they respond. What are you thinking about UK assets as we go into this week?
Well, just stepping back a bit, I actually quite like UK assets as a whole. Overweight UK equities, overweight UK gilts and investment-grade credit. and I suspect that throughout the year sterling can appreciate a bit against the dollar. That maybe says as much about the dollar as it does about sterling. On the positive side, the Bank of England is cutting rates, and I think they'll probably cut 3 times this year, bringing the policy rate down to 3%. Another positive when it comes to the bond market is that gilt yields are relatively generous compared to other developed markets and compared to the US, and that's why gilts have been performing relatively well over recent months. Having said that, of course, the risk is with this political situation that we get back to a point where the markets worry about Rachel Reeves no longer being Chancellor. I'm not sure that the concern is so much about Keir Starmer, but if Rachel Reeves were removed, then I think there could be more volatility. And so if there's a threat of that, then you could see those gilt yields going back up again and sterling weakening. But whether we get to that point or not,
we'll have to see.
It's the million-dollar question.
So is the question then whether that monetary policy direction can reassert itself and become uppermost in investors' minds when actually the last week or so it seems as if politics and fiscal dynamics have been to the fore?
I think at the end of the day, the monetary policy does dominate in most markets. We're seeing an example from Japan where there is a lot of hope on the fiscal side at the moment. But in general, the monetary side, what the central bank is doing, I think, dominates. In the short term, yes, you can get a lot of noise coming from politics. But I would say that over the course of the year, that political noise will dampen down and it will have been a short-lived phenomenon. So, I would focus on what the Bank of England is doing.
Paul, why do you think it's important that Rachel Reeves stays?
That's a really good question. I think it's important because the markets think it's important.
But haven't we moved on from that? The kind of the incident where she was kind of seen as being upset in the House, that obviously had a fairly big reaction. But since then, she's been massively sidelined by Starmer. Is she the important figure that she once was?
I think that she is important in the sense that the fiscal discipline I think did come from her, and I think still probably is.
But if Starmer goes, wouldn't she go as well?
That's what I'm saying. That if the big question is whether Reeves goes, and if Starmer goes, it is possible. It raises the odds that.
Do you think a new Prime Minister would keep her on as Chancellor?
I think it might be an interesting option. Again, we don't know. We don't know who the next Prime Minister would be because there isn't an obvious candidate, which is why Keir Starmer stays in place and why he may survive and see the year out and maybe more than that. But if there were to be another candidate that really did present themselves and that the party got behind them, then it might be an astute move to keep Reeves in place. Whether politically that would be acceptable is another thing altogether, but as far as the markets are concerned, that might be reassuring.
Could we assume that the gilt markets would tame any left-wing instincts of any new leader?
Eventually, yes, but it doesn't mean that you don't get the volatility in the meantime, and so it can be something that's quite damaging. But then the markets step in and do control things. And I think the Labour Party, I don't imagine that the Labour Party would choose a candidate who would destroy the markets. We've had the experience of what Liz Truss.
But do we assume a higher risk premium in gilts, at least in the medium term?
If there were a left-leaning Prime Minister and Chancellor, then yes, for sure.
Are UK equities relatively, I'm thinking the FTSE 100, is that index and those, are they relatively immune to the political instability that we're starting to see in the UK now? UK stocks, in terms of the rotation trade, are they relatively well positioned despite all of this?
I would say that they're one step removed, but they would still be dragged into it if you get this is all hypothetical, but if you get a big move in the gilt market with yields rising and sterling weakening, equities probably would suffer in the short term. Usually it all goes together. But UK equities, as far as I'm concerned on the valuation metrics that I look at, they're still roughly in line with historical norms. The UK market does benefit from a steepening yield curve, for example, Bank of England cutting rates, long yields going up. The bank sector benefits from that, and the financial sector within the UK is important. If global commodity prices are rising, the UK market gets a benefit out of that because of the weighting of energy and metals and mining stocks within the major indices. So there is some insulation, but I think you would see some downside in stocks.
Let's go from the political weakness story of the moment to the political strength, and that's over in Japan, Paul. We've already talked a lot about Japan, but interesting to get your views, because I know that you think that the yen will be the strongest of the major FX, the major currencies. Is that this year? I'm not sure. But, I mean, we've seen a huge amount of volatility on the back of this result. But now the yen is strengthening. I wonder what you think about the yen and its immediate prospects.
It's a mystery to me why the yen has remained so weak, given that the BOJ is one of the few central banks in the world that is tightening. And given that JGB yields, for me, have made a big step towards normalization. So at the longer end of the curve, it's actually quite an attractive proposition, I think. You've got yields that are competitive in a currency that is really cheap. If you look at the real trade weighted index of the yen, it's like 40% below post-1990 norms. So you've got a really cheap currency. I think the BOJ is behind the curve and they need to get a move on and be tightening at least every quarter and not putting a limit on how far they go. Just say, OK, every quarter we're going to tighten. And I think with that, you've got short rates catching up with long rates, and the yen, you know, what's not to like? The yen will benefit from that, from a very weak position. So, yes, I do think the implicit question that you posed me was, I think it will be this year.
Let's link the dots between Japan and a potential repatriation to Japan from the data that we expect out of the US on inflation and jobs later this week. And you expect a pretty robust economic outcome globally. When it comes to the data front, what are you most focused on? Are you concerned about the labour market in the US, and you're making assumptions about further cuts from the Fed?
Yeah, I think the labour market is on the weak side, and yeah, we'll get the data this week. But if you look at the ADP numbers that were published last week and focus on the private payrolls, they are at a very low run rate at the moment, probably somewhere between 0 and 50,000 per month being added, which is way below the 200,000 to 300,000 that we had become used to. So the labour market is not in a great place. The housing market is weak, but the Fed, I think, is still easing. Again, like the Bank of England, I suspect there may be 3 cuts, at least 2 cuts this year, maybe 3 cuts coming from the Fed. And given the easing that we've already seen, I think the US economy probably will accelerate this year.
When's the first hike?
In the States?
Yeah. This year? Next year?
No, not this year.
If the economy re-accelerates, we're going to have an inflation problem.
Well, we're already starting to see that inflation is no longer trending down around the world.
Yeah.
If you take a look at what's happening globally, inflation has stopped its downward trend. Money supply growth has picked up, which, based on my studies in the early 80s, money supply always led to acceleration, always led to inflation. It stopped that relationship has stopped working since. But I would expect that there will be more inflation coming through. But I don't think the Fed is going to hike this year unless something
next year
very big happens. It could be towards the end of next year, maybe into 2027. We're already seeing somewhere like Australia that they have hiked rates. The BOJ, but is in a very different place. The BOJ is running such a loose ship at the moment that it does need to keep raising rates. I just think, given the context of everything that is happening in the US, both politically and economically, I can't imagine the Fed raising rates this year. I'd be very surprised by that.
Interesting, the new Fed chair, maybe more of a monetarist and maybe kind of paying attention to that.
This is the interesting point. So be careful what you wish for. The monetarist idea, but also the shrinkage of the balance sheet idea. It's not obvious. It's not obvious that you're going to get massive easing just because of the new Fed chair.
Great to see you, Paul. Thanks for joining us. Lots of things to talk about this morning. Paul Jackson, Global Market Strategist, EMEA, joining us from Invesco. Let's talk about that inflation story. Rising consumer prices certainly being thought about at the Fed.
What I've learned is that we really don't want to have inflation. Right? Once inflation gets entrenched in people's minds, it changes how the economy evolves. And it's one of the reasons why I think that we need to keep our policy in a restrictive posture so that we get inflation back to 2%. That's paramount. High prices and the prospect of rising prices really do have a lot of families on the edge.
Bostic's worried. Big week of US data. We'll talk about it next. This is Bloomberg.
Welcome back. This is the opening trade. European equity markets then reflecting the risk-on mood that we certainly saw in markets on Friday in the United States and certainly through Asia today. Japanese politics, part of that story, but also the Kospi bouncing, guys. So there's a broader sort of risk-on tech positive story.
Yeah, it continues out of Friday. Nice bounce Friday. People were talking about the Dow this weekend. Who'd have thought? OK, let's talk about what is going on and what's happening this Monday morning. Joining us now for a few minutes, Markets Live Executive Editor Mark Cudmore. Mark, I want to start with this China story on Treasuries. Not a big market reaction. Are we going to get a bigger one as this story develops?
Yes, I think this is a real grower of the story. I understand why there's not been a panicked reaction. This is China warning banks to basically watch out for their concentrated exposure to treasuries and trim where it's excessive. Not for state banks. It is really just a kind of warning to the market. And it happened a couple of weeks ago. So it's during kind of the Greenland fiasco. So it's kind of understandable there's not been a panic. And that's right. But I think this is another notch in the idea that the world owns an awful lot of treasuries. The US government is seriously indebted and is funded by the rest of the world. And given the international policies of the US administration right now, people are increasingly nervous about those holdings. We had, Danish pension fund talking about reducing exposure a couple of weeks ago. This is another notch. And I think as we get more of those notches, you get a game theory situation where no one wants to be left holding the bag. And so I think this is potentially a very big story. I'm not expecting a bigger panic Sunday today, but I think it's a confirmation that we're going to continue to see US yields drift higher because of that concern that people have too much US Treasury exposure.
Mark, let's pivot to Japan, where we are seeing a lot of market reaction. Certainly stocks really strong, up by 3.9% on the Nikkei, for example. We see the yen bouncing. It's been really volatile, I know, through your session, through the Asian trading day. What difference does it make, the strength of the win for Takaichi here?
Yeah, I think this is really massive, a super majority. And I think, Takaichi can do some really, immense things here since they can override the veto from the upper house. So I think people are underestimating how far the Takaichi trade can go. Now, it's obviously difficult to trade because one instinct is to kind of sell the yen, but you're worried about intervention risks. So tactically, that's very hard. But I think the idea of yen, the 6-year bearish trend on, in the yen is sustainable. Now, it might be more on crosses than versus the dollar, but I think that's the long-term trade over the next couple of years, over Takaichi's term for the next few years, is sustainable. I also think JGB yields have higher to go, and I think it's going to be very pro the Japanese economy from a very low base, but I think it continues to be good for Japanese stocks. So I think all the themes of the Japanese trade that we've seen over the past year are all sustainable ones, just hard to trade tactically.
Mark, it's a big week in terms of data out of the US, inflation data, jobs data. What for you is going to be top of mind?
I'm quite bullish the US economy this year. I'm quite bullish the global economy this year, quite bullish global stocks. One of the dynamics we've talked about a lot, though, is that the overpricing in the short term versus the underlying fundamentals are quite positive for risk assets. It's with that in mind that even though I'm relatively positive the US economy, I fear that this week's data set is going to be quite stagflationary impulse. So I think the short-term negative is quite poor, where the jobs data we've seen so far for January is very negative, and yet it's unlikely that inflation is going to be particularly soft. So I think it's going to be a red herring stagflationary signal that we're going to play over the next week. And I think that's partially why I think this week's going to be very tough for risk assets.
OK, short-term stagflationary risks out of the US. Bloomberg Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date, of course, analysis and insight from Mark and the rest of the team. Go to MLIV Go on your terminal. Let's get your stocks to watch this Monday and bring in Chloe Millet. Chloe.
Good morning, Tom. It could be a really good day for UniCredit this morning after it said that it plans to return of 50 billion euros to shareholders through to 2030, and it also beat estimates for the fourth quarter. So all of that could really boost the shares this morning and help UniCredit continue on this really good performance streak from over the last few months. And overall, the tone from the CEO was very optimistic, very positive, with Andrea Orchel saying that the plan is for consistent outperformance in terms of both profitability and investor returns. So definitely a stock to be watching this morning. Moving on to InPost, and the parcel locker company is also in focus after getting bought by Advent International and a consortium led by FedEx. And so this is a deal that values the company at 7.8 billion euros, and the deal could be completed within the second half of this year. So we'd seen a big jump in the shares back in January when the deal was first talked about, and so we could see a very similar jump today as well as the deal is confirmed. And finally, Novo Nordisk could also be getting a boost after Hims & Hers says that it will not be selling cheaper copycat version of weight loss pills. So it will be seen as a big relief for Novo, given that it is pinning so much hope on this obesity pill, and that a competition from a cheaper rival would have been seen as a big blow. So we could see a lift in the shares, but it is worth remembering that it still has to compete with Eli Lilly, which is also developing its own obesity pill.
OK, thank you very much. Our equities reporter, Chloe Melly, of course. I'll throw into the mix NatWest. We've had confirmation of a story that was doing the rounds at the weekend that they are acquiring Evelyn Partners for $2.7 billion in enterprise value. So we'll see if that has any impact on the stock.
Yeah, big day for banks. Barclays tomorrow, isn't it?
Big week, yes,
so
certainly,
we've got a lot coming through in terms of...
and UniCredit this morning,
So we'll talk about banks as we work our way through the second hour of the show. The futures, I think, still reacting to what we saw late last week. Are we going to see the continuation of that theme? US futures
how sustainable was
the
run-up we saw on Friday after such a volatile week?
Yeah. Was it short covering? Does it sustain? I don't know. There's a lot kind of to think about.
Yeah. OK, the European market open. That's coming up next, just in a few minutes' time. Futures pointing in the green. This is Bloomberg.
Monday morning, good morning. Need to talk about Friday before we talk about Monday. So let's talk about Friday. Europe went out here. This is the S&P. So we basically got to price that bit in this morning. There's a load of other stories we need to price in as well. What's happening in China, what's happening in Japan. All of that needs to be factored into our thinking as well. There's a few corporates we've got to fold in too. UniCredit's out with numbers. But that basically is the trade this morning. So we'll see where we are mid-morning, and then I think we go from there. US futures are still fairly flat at the moment, but we've got to price that gap in, Tom.
Yeah, and futures are pointing in that direction, looking to price that in then. On the front foot this morning, European futures looking to add 0.4%. We're looking in terms of the breakdown at energy, oil prices dropping pretty sharply on the reduced geopolitical risk when it comes to Iran. But you're seeing higher metals prices, precious metals, iron ore and copper also slightly higher. So that will all filter through for the FTSE 100, where futures are pointing higher by 43 points. DAX futures lifting gains 0.3%. Anna.
Let's talk about some individual stocks then that could be on the move, Tom. And they come from a host of sectors this morning, some diverse names to put in front of you. UniCredit is certainly one of them, reporting numbers for the fourth quarter today, beating estimates with a focus very much on their plans over the next 5 years to return cash to shareholders, 50 billion euros to investors in the next 5 years through a combination of buybacks and dividends, of course. We're also watching InPost. There's a buyout on the table for this particular business planned by Advent and by FedEx. It's for $15.60 a share, and it closed at $13.30, so we would expect to see some movement on that one at the start of trade. Also keep an eye on Novo Nordisk. One of the reasons it slipped midweek last week was around Hims & Hers and what they were offering, a copycat version of Wegovy over in the United States, and then they withdrew that on Friday after the close here in Europe, and so ADRs went higher. We'll watch to see how the listing in Copenhagen goes this morning. Guy?
OK, let's talk about this market open. Feels kind of mechanical this morning. You basically just got to price in the gap. We'll see what happens as we come through the open. I think we'll check back in and see what the market looks like in a little while. But this morning, the FTSE 100 is expected to go higher, like most of the markets across Europe. We're expecting circa 0.5%. We've got a little bit of that this morning. We'll let it open, climb a little bit more maybe as we start to look around the rest of Europe to get a better sort of sense of direction. The CAC's going to be up a little bit this morning. Big week for luxury as well. Just kind of pay attention to that too. don't ignore the fact that there are some really significant names coming out of France this week in terms of the reporting story. It's up by 0.2%. We're actually not getting quite as strong a market response as maybe we first thought, but the IBEX is out. It's up by 0.6%. The other markets are beginning to climb a little bit more, so the FTSE is now up 0.3%. We were looking for 0.4%, so we're pretty much there or thereabouts. But a positive start, an indication maybe more about Friday than Monday. So let's see how this market develops, Tom.
Top performing sectors so far. Basic resources up 1%. Tech also performing well, up 0.8%. That ties into what Guy has been talking about, of course, in terms of the upside that came through for the tech stocks, at least on Friday, out of the US. We'll see if that momentum can be maintained. Banks performing relatively well as well. UniCredit in the mix, up 0.7% in terms of the sector. On the downside, you've got energy down 0.3%. We mentioned the fact that oil prices have been falling on easing geopolitical risk. Personal consumption products as a sector is also off 0.5%. But it's basic resources, again, top of the list, up 0.9%. Gold and silver jumping again in the session today.
Yeah, to your point, Guy, we're kind of evenly split between the gaining sectors and the losing ones. So we're up by 0.2%, so perhaps not quite the gains we thought we could see. Personal consumer, grocery stores, that sector is under pressure. I can see that Greggs is down by 5.5%. That seems to be the biggest mover on that particular index.
There's a story in one of the papers this morning talking about weight loss pills and Greggs somewhere, I think. ASML, which I think has got its dividend this morning.
Yes.
Is actually up quite nicely. It's up by 0.5%. So that's quite a decent bounce. But it looks like it's the banks that are doing the heavy lifting this morning in terms of the points. UniCredit, Santander, BBVA, all up quite nicely. Some of the defence names are in the mix as well. But it's tech and banks that look like they're doing some decent lifting. Though NatWest is a little softer on its acquisition this morning.
Yeah, acquisition there in the sort of wealthier end of the consumer spectrum. Let's have a quick look at what's happening on the gilts market.
Yeah, actually, the bank I wonder whether the bank story is related to the gilts story this morning, because the UK banks are softer.
Right, and we are seeing a bit of movement in gilts. So this to do with the politics, very much watching what happens with gilts here. We're seeing some selling of gilts. We're up by 1 basis point at the short end. We're up by 2 basis points at the long end. So these are not by any stretch big moves. And I'd also highlight that on Friday, these markets, we saw yields dropping by 3-4 basis points. So we are not even unwinding the moves of Friday. Just to add that context, that doesn't change the fact that these markets are very jittery around political risk. And we are watching that very carefully.
But you're seeing a bid into EGBs, European government bonds, and selling of gilts.
UK,
which is probably worth mentioning as well.
Let's talk to Helen Jewell, BlackRock's international CIO for fundamental equities, and we'll put the gilt story to one side for the moment, Helen. But let's talk about overall markets and where we are and your expectations. Last week seemed to be a week where we all had to question a lot of assumptions about winners and losers from AI and start to ask really hard questions about who the losers are going to be and can we even answer that question right now. That seemed to be a real preoccupation. At the same time, the overall indexes didn't reflect all of that nervousness necessarily because there was a lot of rotation. So what were you taking away from last week?
Yeah, thanks, Anna. I mean, you're absolutely right. The market was actually pretty flat, which is incredible for those of us who were involved in it day to day because there was so much going on. And you talked about Friday where you saw a bit of reversal. But what really the market was telling us last week is you need to have diversification in portfolios because we don't know exactly how that AI story is going to play out. So on the one hand, you had this huge amount of capex being committed. So obviously with a large number of those Mag 7 names. So a commitment of like $650 billion, which is an enormous amount, more than 60% more than last year in terms of the AI spend. And a nervousness of the market of saying, we really need to see some kind of return on investment coming through this year. And alongside that, you also had this situation where, because of Anthropic and Claude, a situation where for the software companies, there was a question mark on actually how much disruption there was going to be. So those two stories going alongside each other. But what was incredibly important is that the money was staying in the market. So you saw a huge amount of rotation. You saw actually from a momentum perspective, 5-6 standard deviation moves in the middle of the week.
Yeah.
And actually what you saw, if you look at, for example, I mean, there's so many ways we can measure this, but one that caught my eye was that the S&P equal weight versus the S&P market cap had its best relative performance since the COVID vaccine was announced back in November 2020. So what you're seeing is not capital leaving the market. market.
Yeah.
But you are seeing a broadening out, and you are basically seeing we need some kind of balance in portfolios, while, to your point, Anna, we actually work through how this might land.
Yeah.
But that's where the opportunity is from an investment perspective.
Okay, and let's get more on that opportunity then, because another way of looking at it would be the realised dispersion that we saw in European stocks, and we've got a chart that sort of points to that, and that stood out as a big theme of last week. But that goes back to the rotation that you're talking about and how we find those winners. What are you thinking about where we lean next then on the AI trade? Is it still about hardware?
Yeah, well, less so. I mean, we're kind of shifting a lot more to the bits that we just think that there are still gaps and opportunities in. There are going to be opportunities in the hardware. For the software space, for example, it does feel the entire sector has been priced down, so trading at like 17, 18 times now, and there will certainly be opportunities there. But whilst we're kind of working out exactly where those opportunities are, what we're still really focused on is where the sums simply don't add up. So one of the areas remains in that energy space. There simply is not the energy and the energy infrastructure at the moment to supply what AI will need in terms of data centers. So we continue to lean into that space. We lean into things like a Prysmian, cable maker. You know, it's actually kind of just needed for that grid expansion, and you need grid expansion for energy, and you need energy, more energy than you needed for a long time. So that's where we're leaning at the moment. I think where there is that more clarity, but that's not to say we don't think there will be opportunities elsewhere as well.
The Nasdaq hasn't made a new high since October. The S&P is kind of going sideways. But to your point about rotation, when we think about flows into just the mechanical flows into the market, if the market just goes sideways, are we convinced that those flows are going to remain? Because they've been a huge factor that has driven the market ever higher. If we don't get index gains, is that a problem?
I mean, overall, you do want some form of index gains. I would also say, don't forget, Europe is actually doing okay. So, and that is because of the flows. We are starting to see those shifts from flows into Europe. We started to see that a little bit last year. We didn't see as much as I think we would have anticipated, especially given where the dollar was. But in some ways, there was a huge amount of reversal we needed in order to get that shift away from the US into Europe. Similarly, if you actually look at the value indices, so if you look at the Russell Growth and Value, you are seeing outperformance in those indices. So, yes, of course, on the whole, it is better from a kind of visual and impact perspective if you are seeing, whether it's the Nasdaq, and we are again seeing the S&P 500 upwards. But actually, it doesn't matter so much. The flows are driving what you're seeing underneath of that. You're seeing outperformance in Europe. The banks, of course, again, today doing incredibly well. So you are seeing shifts in some of those indices. So even if the top line looks a little bit meh, actually underneath that the opportunity is there, and I actually don't think therefore it's a problem for the market.
How active do you have to be?
Well, you'd always have me say you do need to be active within the space. So I think software is probably the best example of where, from an active perspective, the opportunities are going to start really coming if you really understand where the margin really is going to be hit versus not. The other area, again, I'm sorry to keep coming back to it, but it's something I feel so strongly about, is this next generation from the energy perspective. Really understanding the infrastructure story around that is something which needs just the understanding of every nut and bolt that goes into the energy flow.
Is my portfolio going to be riskier if I get active?
It is at the moment, because the level of vol is relatively high for the returns that you need to get. So, yes, you are going to need to get just perhaps a little bit of additional volatility. Having said that, it depends on how you're constructing the portfolio. So I would say, in some ways, the most volatile portfolio you saw last week was one that was overweight US tech. And an overweight US tech portfolio is not how a number of active portfolios are structured at the moment. So, yes, probably a little bit of volatility, but of course it all depends on where your starting point is, guys. So if you're starting from an overweight US tech, absolutely not. You're going to get low. But if you're starting there, then absolutely not. Lower volatility for better returns.
Is there a risk on the software trade that you end up with two losses? One is that AI cannibalizes financial services, asset managers and others. But number two, people aren't willing to pay for it because you can basically pull together open source models and software solutions very, very cheaply. So you don't get the revenue streams that filter back to the data centers and the infrastructure and the picks and shovels that you lean into. There is a scenario where you lose twice on this.
Well, I think that the thing with that, though, in terms of so let me take the first of those first. This is the big question at the moment, is there is a lot being priced in that it is just very, very easy to replicate all of the software solutions that are out there. And I'm sure in some ways that it is, but if you've got critical support and critical software that is needed, it's very difficult to see how that is going to be an immediate switch. So yes, there are question marks about the terminal value, but the big question is what happens before you get to that terminal value, which could actually be a number of years. Of course, speaking as an asset manager, I kind of think that there's probably quite some way to go before you can replace humans in any part of this. The second bit then about the picks and shovels, and you see this in the semis. Semis in Europe again doing very well again, starting off today. What you're seeing in that is the commitment to the spend from the Mag 7, who've got a huge amount of capital that they can invest, is there. And it's real. And it's not just about AI when it comes to things like energy. Air conditioning uses a lot of energy as well. So this is not something where without this spend it's declining and with it it's kind of plus 3%. It is something which is growing as a result of a number of factors, of which AI is probably the one that gets the biggest narrative.
Going back to the rotation trade, does that still work if the Fed doesn't cut more this year?
I think if the Fed doesn't cut, then probably the rotation trade pauses a little bit. I don't think it necessarily continues in the same way. The big nervousness really, and the thing that will actually give more wind to that rotation trade, is that the jobs data. We are starting to see, if you think about the jobs data, we've got non-farm payrolls this week as well, you are starting to see some kind of softening on that. And I think that's part of it. When we're talking about the AI narrative so much, I worry a little bit that we're not really focusing on the macro part of the story. And so you've got the two things going on here. When you see that rotation, the big driver of that is the level of valuations and nervousness about AI. But there is a second part of that, which is perhaps we just need to be a little bit cautious about how perfect the Goldilocks scenario might be. So I think actually, rate cuts, it goes back to this, good is good, bad is bad. Like if we have rate cuts, if rates remain constant, and rates remain constant because there is no nervousness about the jobs trade, I don't think that's necessarily going to be a problem. But if we start to see jobs nervousness, that rotation and the momentum will continue.
President Trump would like that. He likes it when good data is good for stocks. He told us that not long ago, so that would be interesting. Helen, what else are we missing as we sit here obsessing about AI and the losers from it, and where is the pain in software and all of that, and is the trade in hardware done, and where are the pockets we can still find value? Are there things that we're not talking about that maybe we should be?
I think we talk about everything, but I am going to bring it back to the ones where we remain super focused on. So defence is still very interesting, and banks. I feel like we always talk about the banks, and it's always kind of nice when you see something like today.
Does that still fall into our value conversation or no?
It really, really does, because I think we get very tied into value versus growth, and what really it is those stocks that provide you stability within a portfolio. And what the banks are giving you, and you've seen it again this morning, is this huge amount of capital that they are returning to shareholders or potentially doing M&A with. But that is certainty, and that's what basically investors are looking at to ballast against where there is uncertainty in the AI space. So I know we're not talking about it, but don't ignore the banks and those sectors as well.
Never would. Helen, nice to see you. Thanks very much indeed. Helen Jewell, BlackRock's International CIO for Fundamental Equities. Thank you very much. OK, let's talk about where we are with these European equity markets and show you what's happening. We'll get to the banks in a minute. Rheinmetall is up by 2.27%. The defence stock story is back on. Chips are actually having a fairly good day. I think SML is ex-dividend. Schneider's up by 0.7%. Standout story, though, post-Friday, and what we saw with him and hers and the copycats is Novo, the stock bouncing on the news we saw as a result of the withdrawal of that copycat drug late Friday. Let's see what else we're watching. Back to the banks. Chloe Melly.
Good morning, Guy. UniCredit is doing pretty well today. For the fourth quarter results, beat estimates, but also what is really pushing UniCredit in the green this morning is the plan to return 50 billion euros to shareholders through to 2030. So the outlook is definitely very positive for UniCredit, and therefore we are up about 4.6% this morning. Moving on to another bank that is not doing as well, and NatWest is in the red this morning. It agreed to buy the wealth management company Evelyn Partners for £2.7 billion, and this is part of a strategy to access more wealthy clients in the UK market, in the home market for NatWest. But perhaps that price tag is a little bit too high for investors, and we are down about 4% for NatWest. Moving on to InPost, and the parcel locker company is up very strongly, 13.4% this morning after this takeover deal from Advent International and the consortium led by FedEx. And so this is a deal that investors are getting quite excited about. It values the company at about 7.8 billion euros, and we are most definitely in the green this morning. Novo Nordisk is also in the green, which, as you mentioned, Guy, is on the back of this, of hims and hers saying that they will no longer sell this copycat version of the weight loss pill. And this is going to be seen as very positive for Novo, given that it is pinning a lot of hopes on this obesity pill and what it can do this year for the company. And we are up about 8%. On the other hand, the fact that this weight loss pill is happening is maybe not such good news for sausage roll sales. And Greggs is down this morning after being cut to hold by Jefferies analysts on the back of those risks coming from weight loss drugs. And we are down about 3.3% for Greggs this morning.
OK, not good for the lovers of the bacon breakfast roll. Just one item on Greggs.
You sound like you're familiar with it.
I'm just looking at the menu right now. They haven't updated it for a while. There is a vegan sausage breakfast roll, though.
Oh, well, they were almost world famous at one point, weren't they, for the vegan?
For the vegan sausage rolls. There we go. Greggs.
So.
Under pressure. What isn't under pressure is the banking space, as our previous guest was saying. UniCredit promising to return 50 billion euros to investors over the next 5 years. That stock is jumping. This is fourth quarter profit blows past estimates. We'll bring you the details next. This is Bloomberg.
Welcome back. This is the opening trade. It is Monday, everybody. 8:19 here in Europe and here in London. And we have European equity markets going a little higher this morning, actually making better gains than they were just 5 minutes or so ago, up by around 0.5% on the stocks Europe 600. The Xetra DAX getting some decent gains this morning. Travel and leisure stocks doing OK. We've got oil prices coming down, so that sometimes helps those, doesn't it, after the weekend was more peaceful in the Middle East than had been feared. Yeah, defence stocks, though, ironically, up. That's probably the biggest driver in terms of what's driving the DAX this morning. Rheinmetall's up by nearly 3%. Let's talk about banks. Big theme of the morning as well. UniCredit higher. The Italian lender said it plans to return around 50 billion euros to investors over the next 5 years. Earnings were a little kind of more iffy in terms of maybe where the market is this morning, but it doesn't care because loads of money's coming back, and that's kind of the main driver. Let's figure out what is happening here. Our finance and investing managing editor for EMEA is Tom Metcalf, joining us around the table. Am I slightly sort of simplifying the situation? Lots of money being returned, earnings, do I really care?
No, Guy, you're right on the money. It was a messy set of earnings, and there's certainly reasons, you might pick out things to be slightly concerned about, but the big picture is Orchel coming out saying, look, 50 billion through 2030. So you can really see his playbook, right? He is just laser focused on that, and then you've got the much more complex matter of, will he ever manage to get any sort of big name M&A? But frankly, if you're a shareholder right now, you're probably quite just happy. Give me the returns, and Q4 is always an interesting one for UniCredit. So they take a few charges, it becomes a bit messy. But that does set them up nicely for sort of future outperformance across other earnings.
Does that return of cash to shareholders suggest that he's not going to be pulling the trigger on significant M&A? They've built up that stake in Commerzbank. They've struggled, of course, to get anything further across the line, regulatory reasons. Is it a signal that they're going to be more focused on returning cash to shareholders rather than M&A, or you don't read it that way?
No, I don't think yet. I mean, I think he's keeping all his options.
Can they do both?
Yeah, I think it would be a stretch, but I think definitely in terms of under the plan, they could. And, I think like Orchel said, he's got until about 2027 to make a call on Commerzbank in particular. So, no, I think he's a deal maker by heart, right? And so that's the thing I find fascinating is pretty much all the success of UniCredit has been based on the operational side.
Let me ask you about the UK banking sector right now, Tom. We've got NatWest down, 5% or so this morning? 4.5%. They've agreed to buy Evelyn Partners for £2.7 billion. Why the negative response, or is it just, the knee-jerk reaction to spending money on M&A?
I think it's as much that reaction. We normally see it with M&A. So, I think it's about, 3% you were saying down on the shares? It makes sense. Every bank in the UK and, wider also just wants to get into this wealth market and, get that recurring revenue. So, I think it was a pretty competitive deal. So that might be something shareholders reacting against. We knew Barclays were in there right to the last minute. And certainly 2.7 billion enterprise value is a pretty decent price to be paying.
OK, Tom Metcalf, our EMEA finance and investing managing editor on UniCredit, on NatWest, deal making on that front as well. Tom, thank you. Let's get back to a check on UK assets. We did see a sell-off in gilts. We're seeing that, and then it paired, and now we're kind of back again in terms of yields up about close to 3 basis points on the front end, 365 on the 2-year. The 10-year is yielding 454, up 3 basis points, but not particularly dramatic. But the selling is there. We tie that to the UK politics and the uncertainty. Keir Starmer and his future very much in focus. The pound currently trading versus US dollar at 136, a little softer by 0.1%. Let's bring in our Markets Today editor Morwenna Coniam on how the politics of the UK, the political uncertainty, ties into what we're seeing in terms of UK assets. What is the the key takeaway? Are markets bracing for this Prime Minister to step down imminently?
It's not a huge reaction this morning. I think this has been building up for a while. Of course, we had the news over the weekend about Morgan McSweeney, which focuses it even more so. And, the betting odds have crept up slightly there as well. But overall, at the moment, we're seeing yield across the curve up about 3 to 4 basis points. That's not a huge move, particularly if you look back, say, to the summer where there was some concern about Rachel Reeves. We saw them shoot up at 18 basis points. So this just isn't that big compared to previous moments of political uncertainty. The pound is actually only a little off against the dollar this morning at the moment. It is down a little bit more against the euro. But what we've been discussing this morning is that a lot of it probably comes down to monetary policy as well. We had the Bank of England meeting on Thursday, signalling a slightly more dovish direction, and that comes in contrast to the ECB, who seem to be at the end of their policy easing cycle. So that move we're seeing that it is definitely exacerbating those trends already, but is not the only driver of asset moves today.
And Morwenna, it's interesting. If you're in the left of the Labour Party and you want to get rid of Keir Starmer, you're pushing for that to happen. There is another argument that there's a big election coming in May, or at least local elections coming in May, and maybe they won't go so well for the incumbents, and therefore you wait until then and you make Starmer take the fall for that. I mean, you could see logic in either argument, I suppose. And so maybe is the market is it a wait and see here? And given there's a lack of clarity over who would take over as well.
Well, I think exactly your last point there is a certain element of wait and see because there isn't an immediately obvious situation that's going to evolve from this. And I think there is perhaps a suggestion in some camps that you wait it out, you see how things fall out whilst everybody actually gets themselves in position, if that is what's going to happen for a proper leadership challenge. At the moment, of course, Angela Rayner and sort of Wes Streeting have been touted as the sort of front runners, but at the same time, you've got at least 6 other names in the mix as well. And it's not entirely clear that neither of those names are uncontroversial at the moment as well. So perhaps for those who aren't gunning for Starmer to leave, just in principle anyway, there's not necessarily that much merit in forcing the situation.
OK, Morwenna, thank you very much. Morwenna Coniam, Bloomberg Markets Today editor, of course, with us this morning on the market reaction and the politics. It was interesting to me that list of contenders was growing over the weekend. More and more people being mentioned, which it does give you a sense of a lack of coalescing around a
But does that mean it's more likely that Starmer stays?
Maybe.
Because you've got to get quite a big number of MPs behind you to become the next leader. So if the party feels more fragmented, if there are more camps, is it harder to get to that point?
Yeah, perhaps.
That you get a leadership challenge.
We're waiting for more details in terms of the vetting process and what could come out in terms of the emails and the text messages, and to what extent that ties Starmer to that decision and possibly fuels calls from his own cabinet.
And the Met seems to have delayed some of that, doesn't it?
But the Chief of Staff going, is the Chief of Staff about to publish a whole load of other stuff? So that could come this week.
When we come back, we will talk energy markets. We'll join Vikas Dwivedi. That conversation is next. This is Bloomberg.
Happy Monday. This is the opening trade. We are 30 minutes into today's session. So a very strong session, of course, on Wall Street on Friday, making up for some of the losses of the previous week. Then a decent session in Asia, particularly focused on the Kospi in Korea, but also Japanese stocks as well, surging on the back of Takaichi's pretty historic win. European stocks are up 0.3%. You break things down, there is some idiosyncrasies in terms of what's happening in the energy space with oil under pressure. The miners doing very well. That's lifting the FTSE 100 to some extent up 0.2%. Stronger silver, stronger gold in the session today. The FTSE MIB lifted by UniCredit, the banking space performing well, a big return of cash to shareholders. The FTSE MIB up 1%. Over in Germany, the DAX gaining 0.5%. Some of the industrials, some of the defence names performing strongly in the session. Guy, what are you seeing?
Internals 2-1 up versus down. You've got 382 up, 299 down. Volume's a little light. We'll put that down to it being a Monday morning after a busy weekend of sport. Did you stay up and watch the Super Bowl? Let's talk about what's happening in terms of the single stock news. Tom's just given us some of it. UniCredit, certainly one of the standout stories, but Novo's having a really good day on the back of the him and hers pill being withdrawn. It's up by 8%. UniCredit's up by 5%. InPost is up by 13%. There is an offer on the table, Advent-led consortium bidding for this business. The stock responding quite strongly to it. So you're getting some M&A in the market this morning. UniCredit on the results. Novo Nordisk on what is happening in the GLP-1 space over in the United States. Downside looks like this. Acquisitions for NatWest driving that stock lower. But UK stocks are a little lower as well. Lloyds is down by 1.83%. Can I draw a line between that and what is happening with UK politics? That might be a stretch. But nevertheless, UK banks under a little bit of pressure. Gold, silver, gold in particular, going back up again. Pandora responding negatively to that. Its stock is down by 4%, Hannah.
Guy, let's get an update on some of the other news flow this morning. The Japanese Prime Minister Sanae Takaichi has secured an historic election triumph. Her ruling Liberal Democratic Party, the LDP, achieved the biggest post-war victory for a single party in a general election. An extraordinary transformation of fortunes for a party that was on the ropes last summer before getting behind Takaichi back in October. Bloomberg has learned that Chinese regulators have advised financial institutions to rein in their holdings of US Treasuries, citing concerns over concentration risks and market volatility. Communicated verbally to some of the nation's biggest banks in recent weeks, the guidance reflects growing wariness among officials that large holdings of US government debt may expose banks to sharp swings. And Kevin Walsh has called for a new accord with the Treasury Department, overhauling the relationship between the two institutions with a new version of an agreement from 1951. A revamp could prove to be just a bureaucratic tweak with little near-term impact for the $30 trillion Treasuries market, but a more ambitious effort involving a shake-up of the Fed's current $6 trillion-plus securities portfolio could see increased volatility and, depending on the scenario, deepening concern over the US central bank's independence. Tom.
OK, so from central banks on a big week, of course, inflation, jobs data through this week too. What's happening in the energy space right now? You've got Brent currently down 0.7% at 67.60. WTI at $63 a barrel, down 0.7 as well. The focus, of course, on the geopolitics. Oil down after Iran's president described Friday's nuclear talks with Washington as, quote, a step forward, even as he pushed back against any attempts at intimidation. Joining us now for an insight into the impact these talks are having on the energy markets is Vikas Dwivedi, who is Global Oil and Gas Strategist at Macquarie. Vikas, good morning. Thank you for joining us.
Thank you for having me.
What assumptions are you making about Iran oil flow on the back of these talks going forward?
On the crude oil flows itself, we are not expecting any real changes, especially directly vis-a-vis like what Iran may do. And the problem is they don't have a tapered way to approach it. It's too big of a hammer. Either if you do much to the Strait of Hormuz, you block way too much volume, and then the reprisal from the rest of the world, the U.S. in this case, is too strong. So, you go from a rhetorical match to a full-out, military engagement too quickly.
These markets seem to be pricing in a resolution, or at least an easing of tensions. How are you thinking about the geopolitical risk premium priced into oil at this point?
Yeah, we think it's in the range of $6 to $8 a barrel. So it's still very big, and more than 10% of the price. And the reason is the market cannot actually bear the risk. Everybody generally agrees the market is very oversupplied globally. We do too. These are our biggest surplus balances that we've seen since we've been doing these models. Ex-COVID, right, obviously. Yet it's very hard to short this market, because you've got this looming risk. Even if it's a very low probability of some supply issue happening, you can't short this market comfortably.
When do we get clarity enough to short the market? Are there kind of milestones that you're looking at?
Yeah, look, we think there's still a decent chance that there will be some kinetic exchange, right? And it may be
around Iran.
Yeah, between Iran and the U.S., Iran and Israel. it's not our base case, but it's a high enough probability that you cannot ignore it.
Okay.
And it may be the highly telegraphed and even choreographed, like, hey, we're going to tell you when, and we're going to tell you how, but be on the lookout for it, and Iran will do their response. And I think until that has happened, the market won't be very comfortable shorting.
So once you get that, in a weird way, oil prices go down on the kinetic action because we've seen it.
Yeah, exactly. Everybody will have seen, like, hey, you know what? We can still have a measured exchange with each other. Like, no one's going to go full out and try to, overwhelm the other side. And we think Iran is going to be far too smart to try to even encroach into that territory.
Right.
There's a lot of unpredictability with President Trump. You push a little too far, and it could backfire very badly.
Vikas, away from Iran, can I ask you about the global supply glut narrative that has been dominant for quite a while? Because some people really do focus on that, and we see elevated stocks on the water, and they maybe point to that. But others are referencing onshore stocks and saying, actually, in January, maybe they weren't as strong as people had expected.
Absolutely.
What's the detail that we need to be aware of there?
Yeah, great question. And it's certainly, where the oil market would like to focus. Our clients would like to focus on that and not try to predict what Ayatollah Khamenei or President Trump, what we like kind of trying to figure out their MO. Look, we think the market is in a massive glut. Okay, and it's very fair pushback. Well, prices don't suggest that. Spreads, right? The structure of the curve doesn't suggest that. The January, to your point, January stock numbers don't suggest that. So what's going on? What's going on is we've had an unusually large number of one-off outages on the supply side. We think, between higher than expected refining runs, which kept exports down, and outages in so many places around the world, whether it was Russia going down, Venezuela temporarily going down, Turkey, Iraq, Mexico, without listing half the world. It's like you had a lot of outages, and that kept a lot of exports off the market. And that's why December and January have not looked as big on the onshore. The other thing is most of the stock builds have still been in China, right? Their SPR is building rapidly even now, way above what a normal need would be. So,
Makes
normally,
you wonder why.
Well, it does beg that question, right? Normally, countries want to have 90 days of net imports.
Yeah.
China is on track to do 150, maybe even 180 days.
Okay.
So people do ask, why? Why do they need it to be that big, right? And it leads to other interesting questions. But.
Okay. So you do believe still in then the glut story reasserts itself, and that causes prices to drop quite low, 50s you're talking?
Low 50s, Brent, and maybe below 50 for sort of a one touch on the path. Yeah.
And what does that do to investment and, clients, companies' ability to go and invest? I mean, President Trump wants more oil companies to go invest in Venezuela. Do they do that at $50 a barrel?
No, they won't. No. If it gets stuck there, it won't. We don't think it'll stay there. But if you go down that low and for various reasons, let's say it stays there for just long enough, meaning, a couple of quarters, that will slow down investing in oil and gas, especially in the shale, but it'll also disincentivize Venezuela badly. Because then you'll be in a situation where, hey, I have to worry about my employee safety, a really volatile political situation, and terrible prices all at the same time, right?
Yeah.
It's not a good look.
The risk and reward is not... Yeah.
That $50 on Brent, that's stripping out geopolitical risk. That's where you get to. Once we've kind of looked through and we've got some clarity on the geopolitics, you get to $50.
Yes.
And that's for a couple of quarters. That's the kind of time frame you see it at.
Yes. Our struggle, by the way, is, we think the numbers we have forecast on the supply demand still are playing out. But it's easy to forget, we just finished the first year of the Trump administration. So the question for us is, will it be even more active in year two? Will it be the same as year one, or will there be some tapping of the brakes?
When does Venezuelan oil come onto the markets then?
Starting really now. It's picking up. I think some of the narrative that
material barrels on the market from Venezuela.
Yeah, we think of materiality as every 100,000 barrels a day,
right,
up or down, and we think that's already underway. There was probably about 200 to 300 of low-hanging fruit that just needed a little TLC, right? And we think that's coming. The next step will be more oil field services.
Yep.
And then you need E&Ps to actually arrive and drill more. And then the final step will be the downstream refining and upgraders. They have to get fixed. So you'll hit a few plateaus along the way, but we think Venezuela will get some extra oil, and it'll probably arrive in the U.S., you know.
Yeah, which will help gasoline prices into the midterms. Thank you very much.
Yes.
Trump wants to accelerate the U.S. economy into the midterms. He's hoping that we see a pickup in economic activity. How many barrels does that take?
From the oil industry?
Yeah, no. If we're going to see if we see a faster economy in the States, is that positive for oil prices? Presumably, it must be. Is there a demand picture that comes with that accelerating economy?
Oh, absolutely. Yeah. Look, we actually think 2025, the global economy took a lot of body shots, right?
Yep.
And it was resilient. And this year, we think it's going to be much better. So you get more driving globally, you'll get more driving in the U.S., more goods being moved. Jet demand is sort of flattish right now, but we think that'll pick up. So all in, it'll be very positive for the demand side and petroleum refining. But if along the way prices stay elevated because of the geopolitical situation, you get both. You get the incentive to drill more and produce more oil, and you get good demand to refine it. And it actually ends up being a nice 1-2 positive punch for the U.S.
Okay, interesting in terms of how that changes the demand dynamics for oil then through the rest of this year. Thank you very much, Vikas. Really smart insights on an important day again for the oil and gas sector. Vikas Dwivedi, who is oil and gas strategist at Macquarie. Coming up, ESPN says the Super Bowl winning Seattle Seahawks may be up for sale. What is the team's current valuation? We're going to give the answer when we come back. This is Bloomberg. Well, before the break, welcome back, by the way. We asked, what are the Super Bowl winning Seattle Seahawks valued at? The answer, $6.6 billion. That is according to online digital media platform Sportico. ESPN reporting that the NFL team will be up for sale. After the Super Bowl, the Seahawks sale will likely be the biggest NFL deal ever, with the potential to surpass the purchase of the Washington Commanders in 2024 for about $6 billion. The headlines have been focused not just on the win, but also on Bad Bunny. Anna Edwards is a fan. Anna.
Thank you very much. Yes, I thought it was a Bad Bunny gig with some football on the side. Is that how it actually went down, maybe?
Certainly seems half-time's always important. Everybody takes that seemingly very seriously.
They do, and the business of sport, that seems to be the headline here at Bloomberg. Right, let's talk about what's going on in Japan, because this has been an incredible weekend for Japanese politics. The Japanese Prime Minister, Sanae Takaichi, has secured an historic election triumph. Her win now positions her as the nation's strongest leader in the post-war era. Speaking on Fox News, US Treasury Secretary Scott Bessent said the US would now be stronger in Asia.
Japan, the prime minister called a snap election, the quickest snap election in Japanese history. And boy, has she had a big victory today. She's going to have 2/3 majority in the upper house. President Trump endorsed her last week. She is a great ally, great relationship with the president. And when Japan is strong, the U.S. is strong in Asia.
The US reaction there. Joining us now from Tokyo with the latest on Takaichi's win is Bloomberg Japan economy and government reporter for Bloomberg, Erika Yokoyama. Really good to have you, Erika. So the election win was expected, but the scale of it quite unexpected, perhaps. How does that change the political landscape?
Exactly. As you said, the scale was far larger than any forecast by local media, which was predicting roughly 300 seats. So the LDP secures 316 seats. As you said, this is the largest number for a single party in the post-war history, and it's also exceeded something called absolute stable majority threshold of 261 seats, allowing the party to control all 17 committee chairmanships and have enough votes across relevant panels to smoothly pass bills and budgets. This is totally different landscape from last week when the LDP managed a slim majority of 233 seats, even with coalition partner Ishin and some independent lawmakers. The LDP picked up many seats from the Centrist Reform Alliance, which is newly formed opposition party by Komeito, and Constitutional Democratic Party, which used to be the largest opposition party. So now Takaichi's ruling coalition finds it much easier to push forward with whatever she wants to do, from economic package policy or defense build-up, without much obstacle from other parties.
Erica, on that list then, what is going to be top of the list for this newly emboldened Japanese Prime Minister? What is she going to prioritise?
Sure. Yeah, the inflation has been a long-term concern, but before doing anything, she first of all has to get the budget for the year starting in April through the diet. That's priority. You know, the ruling coalition is still in the minority in the upper house, so some amendments there are possible actually, as we saw last year. But given now the LDP has a solid majority in more powerful lower house, this should be a manageable task, I guess. Then once that budget checkbox is the budget is done, she probably moves on to sales tax cut. She already pledged suspending 8% consumption tax on food for 2 years. She now needs to think about how she will finance 5 trillion yen required for the measure. Then there will be potential market turmoil because of that.
Erica, great stuff. Thanks for the update. Really appreciate it. Erica Yokoyama in Tokyo, updating us on the Japanese political story. One of the kind of risk events that we've been watching into this week. There are plenty more still to come. Keep an eye on what's happening in South Africa. You've got the Indaba conference taking place. Plenty of Fed speeches coming through as well today. International Energy Week is kicking off in London. You're going to see plenty of names coming through. NFIB, small business optimism. That feels like an important data point, given the kind of the rotation we see towards smaller mid caps. Lots of data out as well. US jobs Wednesday delayed. UK GDP Thursday, Friday, we get US CPI, plus the Munich Security Conference as well. So that's going to be an interesting one to watch out for. Let's talk about kind of where we are with these markets, though. Big day Friday, kind of tough week last week, big day Friday, equities come back. Are we on a sounder footing, or was that just a short covering rally that still leaves us with potential for volatility? Scarlett Montgomery-Kerning from our markets team joining us, Michael Basika, European equity strategist, joining us. What do you think, Mike?
It's a good question. Look, we had a huge washout in software stocks.
Yep.
You look at positioning now on that sector. It went from 18% last year, according to Goldman Prime Book, into 3%, which is a record low. So literally, it's been completely sold, especially on the hedge fund side. I think now the real money, long money, is also selling. But we are honestly, we had a proper sell-off on those, and not just in terms of volume, but also in terms of proper exposure from asset managers. So you could argue that we have seen a lot of the capitulation in there. Does that mean we need a rebound, or does it mean it's uninvestable and no one wants to touch it? Maybe. But I would say the bulk of the outflows has happened.
So that's a key dynamic, and it's interesting that earnings actually for software stocks in the S&P 500 are forecast to rise, not drop. The rotation trade is also part of that as well. How convinced are you that is a sustained theme?
So the rotation trade has been ongoing for some times now. We've seen a rotation out of US equities into international equities, Europe, Asia, emerging markets, and also within the US market, there's been a very strong rotation into small caps, into other sectors. Last week, if you look at ETF flows, we had a record outflows from tech ETF into other sectors of the US market. So all the other sections of the market are getting inflows. And you can see it with the outperformance of the S&P equal weight compared to the S&P 500. This is very typical of like a proper rotation going from one side to the other.
Yeah, absolutely. And we saw it in Europe with lots of people talking about dispersion. Realised dispersion in Europe was pretty high. So the volatility, there's drama in the narrative, but it's not shown at the overall index level. Skylar, what did you take away from last week and that dynamic that we were just hearing about from Michael?
Yeah, I mean, I think you need to be more considerate when you're picking stocks, and that's something that's come across the board, right? But generally what you see is that when you have these diversions between earnings and equity performance, they don't last for very long, because at some point you derate and you become cheap enough that people still want to buy that. And so I think, eventually you'll get there with software. I do wonder more long term though, because we had this massive divergence between US and European equity performance versus actual earnings, whether or not that corrects, because that implies a bigger move, and whether or not the US begins to outperform again as those earnings have come in quite strongly.
Is it getting harder to buy the dip?
I think it is. It definitely is, because people are cautious around the idea that some of these things are overpositioned. Maybe now that we've had to clear it becomes less hard. But I think it also becomes harder because you're worried about how you hedge that, right? We've seen that precious metals aren't helping you as much as they used to. People are worried about government bonds more generally, about yields rising on higher term premium. Just there's greater risk within the system. And you have all these headlines going across you that just make it harder to see what it is going forward, especially because some of the moves aren't fundamentally driven.
Skylar, I wanted to ask you about what's going on in UK politics, because we have not a huge amount of movement in cable, but the dollar's on the move, so there's that. But in the euro against the pound, it did start a couple of hours ago, but we have this gradual weakening of the pound against the euro. Bond markets a little calmer than they could have been given the politics in front of us. Things look hectic in UK politics. We don't know where this is going to land, but what do you make of the movement in FX this morning?
Yeah, I mean, I think it's because we've had a couple of these kind of shaky events within politics in the last few months, and so there's a higher bar for reaction. What I would say, though, is we were doing so well on the pound. As in post-budget, fundamentals were looking stronger. Growth had become perkier, inflation had peaked, so you could get those cuts. And that means that there's not a risk premium priced in anymore. So you had the gap between rate differentials and Euro GBP close quite significantly, and that political risk isn't going away. There's a by-election at the end of February, there's local elections in May, and it's just downside risk from there. So you should probably price a bigger premium.
Michael, do I hide out in UK stocks, though? Because if the pound goes down, doesn't that mechanically help the FTSE 100?
It does help it. The thing is, investors are not interested in UK stocks.
No.
They don't want to buy.
Just
UK
another reason not to buy.
No, actually, that's not true.
We find some voices who are quite.
The Frenchman says with a sense of glee.
Yeah, we do have some guests, and they're not all British.
The Frenchman would say that the CAC 40 is doing way worse than the FTSE 100. So I'm okay with that. It's fine. No, there's a lot of good stocks in the UK. It's still a lot cheaper than a lot of other markets. So there is some interesting flows there, but every time there's something going on with the UK government, people just want to stay away. Oh, this is UK stocks, so I'm staying away.
Yeah, we've seen that before. Michael, Scarlett, thank you very much indeed. That wraps up the show. Plenty more still to come. We've got the European Commissioner for Competition coming up very shortly on the pulse. Look forward to that. This is Bloomberg.